Hello, everyone. I hope you're enjoying the Business Revolution week so far. We're very excited to be bringing this special event to you, and we thank you for your attendance. My name is John Hannon, and I'm an analyst with Kalkin Ginsberg. I wanted to run through a few housekeeping items before we jump into the informative roundtable that we've got for you. First, I want to thank our wonderful sponsors and subject matter experts for their continued support. Without them, none of this would be possible, so we're very thankful to them. Second, I'd like to give a disclaimer. The information that you're about to hear in this roundtable discussion is not intended as legal, financial, or advice of any kind, and it may not be used as such. Advice must be tailored to the specific circumstances of each case. Every effort has been made to ensure that this information is up to date as of the date of this roundtable. It is not intended to be a full and exhaustive explanation, nor may you use this information to replace the advice of your own legal counsel. The speakers assume no liability for any verbal mistakes or other errors contained in this roundtable, or for changes that occur in the future that affect anything that's discussed therein. So without further ado, I'm going to hand it over to Mike, and we'll jump right into this informative roundtable. Thank you.
Hello and good afternoon, everybody. This is Mike Ginsberg, President and CEO of Kalkin Ginsberg. I'm excited to be with you today. We have a very important topic. We're going to be discussing buying and selling debt portfolios. What are the important things to think about in today's marketplace? We carefully selected 3 subject matter experts who together, I will introduce them, who together are going to discuss how COVID-19 has affected debt sales. And we're going to look at this in a variety of different ways. Without any interruption, let me take a moment here and introduce our team. First, Andy Carlson. Andy is Managing Director and Head of Garnett's Charge-Off and Bankruptcy Loan Sales Group. Andy joined Garnett in 2012, and he has managed the sale of over $10 billion worth of loan portfolios and other transactions. Overall, Andy has presided over the execution of more than $35 billion in consumer loan sales, purchases, and corporate capital transactions. Thanks for joining us today, Andy.
Thank you.
Greg Paulo, he's the Vice President of Business Development for Flock Specialty Finance. I've known Greg now, he's been in this industry for decades, and I've had the fortunate experience of interacting with him on multiple occasions, a number of different things, but he's been firmly entrenched in this marketplace for quite some time. Greg and his team help provide capital to buyers of non-performing consumer debt and originators of subprime performing assets. And this really falls outside of the traditional banking system. As I said, he's got more than 20 years of professional experience in and around this industry in a variety of sectors, including government and various consumer areas, as well as the mortgage industry. Greg, how you doing today?
Good. Thank you, Mike.
Thank you for joining us. And last, but certainly not least, we have Tony Spencer. Tony Spencer serves as the Executive Vice President of Sales Operations for NLEX. He has joined the company in May 2007. He's assisted on a number of premier financial institutions with executing on their charge-off sales. Prior to joining NLEX, and important for us to point out, Vice President of Recoveries and Operations for about 14 years with JP Morgan Chase Card Services. And in this role, he was responsible for both strategy and recovery efforts on Chase's small $3.5 billion private label portfolio. He's overseen things like credit card assets, international collection teams, agency strategies, attorney networks, bankruptcy processes, you name it. I think we've put together the dream team here of folks who really understand this marketplace, and we're going to start dissecting really what's going on, so you as creditors in this marketplace and also service providers in this marketplace got to think about what's going on and maybe incorporate it into your own planning. I will start things off here with a question. Maybe Andy, if you don't mind, you can get us started. But we've all been impacted by COVID, both personally and professionally. It's in the news every single day. We know this. It's also a political fireball. It's just a really, really emotional, hot topic. Andy, maybe you could start us off telling how has this affected debt sales?
Well, certainly. I mean, we can break it down into a number of different aspects, whether it be pricing, execution, timing, and general concerns that people have. Maybe I'll start off with pricing because that's probably of interest to everybody. What we saw here at Garnet was actually kind of an interesting event with pricing, where initially when COVID hit, I don't think it's any surprise to anybody that pricing dropped substantially. A number of different factors, concerns that the market had about long-term performance, how much was capital going to cost, and a number of different things that were, cited by a number of buyers. But since then, what I think is more interesting is that over the last several months, pricing's actually rebounded substantially. And as folks are thinking about transacting on portfolios, they're starting to observe pricing that may be at levels similar to or even above what they were prior to COVID hitting. A number of different factors for that too. But before we kind of jump in and change topics, I guess I want to turn it over to somebody else to see if anybody has any different observations about what you've seen on the pricing side.
Andy, we've seen very similar type transactional data where it's pricing. I think that buyers, just out of abundance of concern, asked for pricing concessions at the onset. So late March, early April, hey, what can you do? No one knows what type of impact this is going to have. But I think the biggest aspect of it is probably no impact was seen in the early onset because of government stimulus and for forgiveness that was provided by the financial institution. So from a timing perspective, a bit off of what I think most of the buying community was looking for or thinking was going to have an impact. That being said, we're seeing very similar trends where probably somewhere between a 20 to 25% price concession was given up in late Q1, early Q2 of this year because of COVID concerns. And we've seen that rebound as well. We purposefully locked in flows that were going to end towards the end of Q2 and then retested the markets for our clients so that they could have a better understanding of what impact that was going to have. And again, very similar to what you're seeing, we're at or above pre-pandemic pricing.
We've seen some very similar results. Obviously, people are very concerned about the pricing on an ongoing basis. The uncertainty is what is killing our clients. And so, one of the big things that we're talking about is how long do you lock into a flow? Because we think, when we take a look at our economic models, we certainly think that these trends are short term. We don't know what it's going to look like in 12 months from now. And so as we talk to these buyers and we're talking through, what your strategy is to bid on paper, we're recommending, shorter horizons on these flows, at least for the near term, until we have a better understanding. Is there going to be a second stimulus package? Do we see a recovery coming in 2021? What types of things do we think are going to occur? So you're not locking yourselves into a financial commitment when you really don't know what those liquidations are going to bear, 12, 18 months out.
Greg, are you finding that your clients or anybody on either side of the equation is accepting of that, or are they really using this to negotiate?
It's I think certainly we're seeing a little of both. We've seen some creditors. Creditors are very, very sensitive to compliance issues. They don't want to put their buyers in a position where they're doing things that are maybe not in the best interest of the paper and create headline risk. And one of the ways you do that is not put them in a financial bind by selling something for more than it's worth. And so some of those buyers or sellers are extremely, in our estimation, extremely considerate and are understanding and are willing to make some adjustments. There are others that are a little more firm and want to hold firm with their pricing, hold firm with their contracts. And at times that can be very detrimental to the actual buyer And then what does that buyer do with that paper?
Tony and Andy, let me just thank you, Greg. Let me just ask you kind of as a follow-up to this, because pricing is such a critical topic. And Andy, I'm so glad you picked it first. As we're sitting here kind of talking about this, those that were in the business back in just, what has it been, 12 years since the Great Recession, right? First the mortgage crisis, the financial crisis. We could even look further back at, 9/11, right? These events that took place. Obviously, the difference between a recession and a pandemic is tremendous. But are you finding today, my question is, more or less cooperation among the cast of characters than you have, in previous events, whatever those events might be that might have impacted debt sales?
Tony, do you want to go first on that one?
Sure.
Or-
Yeah, that's fine. We've seen a bit more cooperation through this process. I think that when the Great Recession hit, there were no one in this industry had really experienced that type of a 50% price drop overnight, effectively. I think that as people look at this as more of a partnership and as compliance is driving a lot of this, buyers and sellers work better together, and at least opening the dialogue and saying, hey, here's what we think will happen. I think that it's just been a lot easier since it's more of a partnership, whereas, pre-2008, it was the less you knew about your debt buyers, the better. It's arm's length transaction. Now it's a relationship. So I think that it's been much more cooperative throughout the process.
That's interesting, because I've had a little bit more of a mixed bag where, clearly there are those that are cooperative for all of the reasons that everyone cited, but we've also had folks on both sides where there's been less cooperation, and I think that some of that seems to be due to the fact that there is this built-in or embedded idea from, hey, you've been through these past economic cycles and these things happen, and so there's I don't know how to say it, but there's the view to the buyers of, you've been through this before. Were you not properly pricing for unknown things? Clearly, we've never been through a pandemic, but we've been through a recession. We've been through 9/11. We've been through, a number of different things. And so, I've actually seen some resistance to it too, where folks have just said, well, you should have priced that in, because everybody knows that every so many years something happens, and this time the complexion of that something is just different than it has been in the past. So but I have seen a good amount of cooperation, but I've also seen some people that are just saying, haven't you used your experience to properly adjust? So it's
Yeah, I would agree with that too, Andy. I mean, we've seen, not every one of our clients has been rolling over and saying, hey, let's give it up here. But there's been a lot more dialogue, where in the past there was just no dialogue. It's more of a, help me understand why you think this. Did you not price it out, just like you've said? But I would say that we've seen about a 50-50 give on pricing. So
one of the biggest things from the financial crisis, I don't want to go all the way back to 9/11 again, but the financial crisis is a lot of debt buyers couldn't sustain the time period where loan originations shrank up to basically nothing, and there was less product out there and significant pricing fluctuations, right? Fast forward now to today, there are other concerns, like, for example, the vast majority of states and cities prevented suing on these accounts, right? But also, go one step further, the courts were closed. So even if you could sue, you couldn't go through the process of a normal process of suing. And the courts have been extremely burdened with other things. So there's been a lot of impact that, yeah, I hear you, Andy, you can forecast right into your models, and you can make some assumptions. We do this all the time. I sell businesses for a living, and it's not much different. When 9/11 hit, people said to me, well, you know what? You could throw your forecasts out the window. You know why? Planes hit buildings, and buildings go down. And you're going to tell me you forecasted that into your model? And of course we did it because, 9/11 was this event that never took place before. In my lifetime, I've never dealt with a pandemic. In my lifetime, I never dealt with a global recession, right? So, I mean, you got to learn, but you also got to have that flexibility. Let me ask you guys, let's broaden it, Andy. You brought up these topics, and I think starting with pricing was great. But what about the other aspects? Let's talk about, not each of them separately, but execution and process, I think you said, but overall the concerns among buyers and sellers. Do you think we're getting through it with COVID, or are these concerns still out there and they're still being dealt with?
Well, I think the concerns are still out there and being dealt with, from all sides of a transaction. So, and working with sellers, you've got the sellers that are, they're having a very interesting experience. And again, something that just couldn't have been predicted. If you'd have asked me when COVID hit, what's going to happen to payment rates, I would have thought, well, they're going to tank, and they're going to tank for everybody. And in reality, there was stimulus, there was, call it alternative programs that were made available for rent forgiveness and things that 6 months ago we would have never thought existed. So some of the things that I expected never really materialized. And so as people are working through that, and I've talked to creditors who have said, well, shoot, I'm changing my strategies because I'm having record low losses. I'm having record setting months. My charge-offs are down as a result of it. My payment rates are up. So they're even rethinking their sales strategies in the context of, this is my recent experience. Now, is that recent experience going to continue to carry through? Probably not. These programs are going to end. People are going to have to start paying their rent again. Various moratoria around the country are going to be lifted that are preventing repossessions or litigation. A lot of those things are going to go away, but nobody really knows when. And I think that's the one thing that we really struggle with a lot of the creditors that we work with, as well as a lot of the buyers, is when do these things start to happen? How do we price that in? And everybody says, well, gosh, I just don't know.
Good point.
Not to go back to pricing, but one of the, because of all of those impacts and there being a reduction in supply, I think that that's one of the contributing factors to pricing, is that people have businesses to run, and there's less product because of a lot of those factors. So now they've got, another set of issues to deal with, which Greg's probably well equipped to talk to, but they've got to both fill their machine, but at the same time, they've got to perform on what they're doing. And so, from a concerns perspective and from a what's changed perspective, we're definitely not out of the woods, and people don't seem to be comfortable with where things are. It seems like there's almost a weekly adjustment of the dials, so to speak, as far as how people are behaving.
Yeah, well said. Greg, Tony, anything you want to add to this important topic before we move on to the next one?
No, I think Andy hit it pretty well on the head. We've seen some similar aspects here where volume has gone down. Not many of the players, unlike 2008, 2009, not many of the players have dropped out of the ball game. So there's still the same number of players trying to get the smaller volume. So that's contributing to the price increase.
Not saying that this is a great situation, but if you think about it, it's kind of exciting from the standpoint that there are so many factors in play. We've seen, when we take a look at our entire inventory, we saw small balance payments skyrocket in terms of average payments. Large balance fell off the face of the earth. And so collection agencies, obviously the engines for our debt buyers, our clients, are collecting more than they did in the past, which is very interesting. The other thing that they did is a lot of these companies cut back on their staff, pared back to their just most productive staff members, and their profitability has grown. So in this kind of short-term period of time, we're seeing something unique from our debt buyers that are seeing some pretty healthy profits in this short window in anticipation of something happening later. And so, as Andy had mentioned, that's one of the components to why there's a rising pricing, limited demand, They want to keep this engine going. They want to keep these employees employed and keep their systems running, which creates a fervor to bid up prices even more. The problem is they don't know what the next 12 months are going to bring. And we know that these curves are being drawn out for 36 months or even in some cases 60 months to get their money back. And I think the real problem is going to come in month 18, month 24. What happens to our clients at that point in time?
Yeah, Greg, excellent points, all of you. I'm going to ask you, as you see things kind of unfolding in today's marketplace right out in front of us every single day, and there are twists and turns in the marketplace that raise concerns really on both sides of the equation. The buyers have concerns, the sellers have concerns, right? Do you find that the cast of characters has changed considerably? We know who the active sellers were, prior to the great pandemic that we're dealing with. We also know who the most, or maybe the largest or publicly traded debt buyers were out there who were active in the marketplace. And there's certainly others that aren't publicly traded that are active as well. My question for you guys, whoever wants to answer it first, has the cast of characters, buyers and sellers who are really out there doing things right now, changed over the last, say, 12 months? Anybody want to jump into that?
Yeah, I'll take it. We haven't seen that many new characters entering the market.
As buyers or sellers?
Buyers or sellers. There are some sellers that don't fall under traditional credit product that we're starting to see, hey, is there value in our asset class? So we're starting to hear that. But
isn't
from
that more
buyer,
of an emerging market class or something different, not because of the pandemic, right?
Yeah, it's just more of an emerging product where there's been an accumulation of assets over a period of time, and now it's, what are we going to do with it? Is there a way for us to have an outlet for this? But from a buyer perspective, at least from our perspective, we're seeing pretty consistent participation with, over the past 12, 24 months with very consistent people that participate, both on the public side and the private side.
Tony, before I go to the other two, I just want to ask you, so consistently you're seeing the same. Are these experienced, seasoned buyers and sellers, or are they kind of new to the fray as buyers or sellers? Forget about the emerging asset classes.
I think that they're a pretty seasoned group. We'll see. We get roughly 5 to 10 new entrants in that attempt to look at assets through our marketing channel. We have a fairly extensive process, so about 10% of those buyers get through. So they'll look at it, but it's really the folks that we've got transactional history with more recently that are more consistent to win bids and look at even the emerging markets.
Greg, Andy, how are you seeing that?
I think I don't have the same visibility as Tony and Andy on the creditor side and kind of what they're thinking. But from the debt buyer side, I completely agree with you, Mike. I think it's the experienced guys that are in this market. Now, we've seen a number of new entrants into the market, but they're guys that were in the business earlier with other companies, either moving and starting their own firm, or winding down one firm and opening up another one. But what that tells me is that there still are some significant barriers to getting into the debt buying market. You just can't come off the street with a pot of money and start buying debt. You need to have that experience. You need to be able to overcome some of the hurdles, the compliance hurdles, and the regulatory requirements. And what from our perspective, as we see the high APR and the payday loan sales markets really get squeezed, we're seeing this kind of lumping of the middle market debt buyers getting bigger. We're not seeing a lot of the small guys moving up to the middle market, and we're not seeing a lot of new guys coming into the market because the barriers are too difficult. it's too difficult for them to obtain paper. They don't meet the qualifications for a seller to bring them on board, because you need some minimum requirements: time in business, assets under management, experience. They don't have those things. So it becomes very, very difficult for them to get into the market.
I think, Greg, you bring up an excellent point, which is barriers to entry. Over the decades that we've been in this business, and even initially, if you had a rotary telephone, right, and you had a Rolodex and maybe an ashtray, you'd be in the business of collecting bills. Today, obviously, there's not just technology advancement. You got to deal with a whole cast or a whole list of requirements, and capital cannot be a constraint, obviously. And we'll get back to the capital and the underwriting process just momentarily. But you're right. I mean, there's really just a line in the sand for those who can and those who just can't participate. Andy, are you seeing the cast of buyers and sellers, different? How are you seeing things based on the same question?
Yeah, sure. So, I mean, I can echo a lot of what both Tony and Greg said about the buyers. We're seeing a lot of the same type of activity, the same buyers. I kind of liked where Greg was going with. We're not seeing the same kind of graduation or new folks coming in, and the market really changing and turning. That's consistent. But one thing we are seeing a little bit different on the seller side, and again, I don't want to keep going back to COVID because we're going a little bit of a different direction. But one of the changes that we're seeing from a seller perspective is that a number of those folks that would ordinarily have a cyclical sale, or some of the usual cast of characters, are actually pulling back a little bit because a number of different reasons, but they've hit their numbers. Because of COVID, they're being given a free ride by their investors. They don't, their stock price, I know that's PRA and Encore, it's not being punished. So they don't need to do things. I'm sorry, those are buyers, not sellers, but they don't need to do things because their investors aren't punishing them because they're giving them a free pass because of COVID. So they're really holding back and saving some of their dry powder, which is, exacerbating the supply issue. But from I think you were going down the barriers to entry path. One of the things that we're seeing a lot of is that the time to close a deal is taking a lot longer because of those barriers to entry. And even during this period where you think that with things being remote and everybody wanting to do things, that they would try and shortcut and hurry things up, when in reality, what they're doing is they're extending and dragging things out because there are now additional complications in closing, in compliance. And so the barriers to entry during COVID actually went up, even though the technology and the resources and everything that the industry's done over the years to, I used to make this joke many years ago about PCI compliance, and that was such a hard thing back in the early 2000s. And the joke was always, well, somebody's going to create Joe's PCI compliance shop and everybody's going to buy PCI compliance off the shelf. The industry has a lot of those products, but despite all of that, it's actually harder in some instances to transact because of the barriers to entry. The compliance requirements are higher. The documentation requirements are higher. Even for people you wouldn't expect those kind of requirements from, they're expecting things this year that they weren't even talking about last year.
Well, I think that creates a more solid industry for everybody who participates. Having those in advance, those kinds of requirements allows for a smoother process, maybe even accelerating what you said has slowed down. If everybody knew what they were up against and they prepared properly for these events, you guys wouldn't be left in the middle trying to facilitate a transaction over months that shouldn't take months to facilitate. You bring up an excellent point, and it's actually a good segue. Greg, I'm going to ask you to respond to Andy's comment right now, specifically about the publicly traded, the Encores, the PRAs of the world. You might see things a little bit differently than what he said, but can you speak to their volumes and purchases, over the last 7-8 years?
Sure. If you could put up the slide that we have. we have gone back and taken a look at the volumes from the publicly traded companies. And what we've noticed, just in terms of what they publicly report, that the volume is so far down, it's almost down to 2013 levels of their purchasing. And so that spurred a couple more questions from our perspective. And we went in and we looked at some of the lenders that have public records, and we went into their portals, and we found out that, you know, in the February-March timeframe, a lot of these lenders tightened up underwriting and stopped issuing as many loans as they were doing in the past as COVID onset. And of course, here we are 6 months later, when those charge-offs would normally be filling up the sales buckets, they're not there. So we have kind of two kind of influences. We have lenders that didn't lend back in February and March, so the volume of charge-offs aren't there. And then we had the stimulus money come out, and folks, I mean, quite honestly, had more money than they knew what to do with. They had more disposable income, and they took that money and paid down debt. If you can bring it down now, if you like. But what we did is we went ahead and we took a look at, you know, outstanding debt on the Fed. I guess there's a couple of databases that the Fed publishes that we track on a regular basis, and we're seeing that this is the first time in a recession that people actually paid debt down, and we attribute that primarily to the stimulus. People aren't going out to dinner, they're not going to movies, they're not going to the bars, they're not going on vacation, and they had the stimulus money. And it appears that they took that money and took this opportunity to pay down some of their debt. And so we're watching very anxiously to see if there's a second stimulus package that comes out. And then when the stimulus runs out, we're monitoring unemployment rates. And the one thing we do know, the unemployment rate is not going to be at the same level it was pre-COVID. We're running, 8% now, 8 or 9% right now, when we were looking at a 3 to 4. If that keeps up, we know that there will be charge-offs, significantly more charge-offs than there are at the current levels. We just don't know whether that's going to be in 3 months or 9 months.
Excellent points, Greg. Andy and Tony, is there something that you want to add on that particular point?
I'd say from our perspective, Mike, that we're seeing very similar trends. Kind of a perfect economic storm where stimulus was injected, unemployment rates were on the rise, but the unemployment amount of money that people were receiving because of the stimulus and the increase in just what was being paid out was a perfect storm. They had nowhere to spend it. The country was effectively at a standstill, so they couldn't go anywhere to spend the money. So they did a responsible thing and started paying down their debt. One other thing that's kind of contributing is the issuers do have a forbearance program that they've instituted, at least most of them do, with their consumers. So that's also kind of dropped down the volume that we're seeing from a charge-off perspective. And that pig in the python will emerge at some point in the 3 to 9 month term.
Thank you. Greg, can you start us off talking about underwriting and specifically what it's looking like in today's market, how it's evolved, what can we expect maybe after the election going into, I don't want to make this an election topic yet, but what can we expect in 2021 and going forward from an underwriting perspective?
I will tell you from our perspective over at Flock, we are building in uncertainty into our curves. We're trying to build in some additional conservatism into our curves, expecting that in 9 to 12 months, we're going to see a significant decrease in liquidations. And we think that's a temporary decrease, but it'll be a decrease. And, when COVID first started, we thought, okay, we're gonna discount our curves 25 to 50%, depending on the asset class, and we're gonna go ahead and do that decrease on our curves for 9 months, and then we'll slowly build it back up over the next 12 months as the economy repairs. Well, we were wrong because our curves didn't deteriorate in the first 6 months of COVID. They actually, in some cases, stayed flat or increased slightly. And so we still think, based upon the economic models, the unemployment rate, and some of the other economic factors we're seeing, is that we still need to be conservative. And we think that we're going to get that dip. We may have misdrawn the curve, that maybe it's a little better now, but we do expect it to drop off at some point in time as unemployment starts to weigh down the liquidations. And so, the one thing is I don't think anybody has the perfect economic model. We're just doing the best we can. And it's the uncertainty that is really driving some of the conservatism in our models. And then you take a look at, you mentioned the election, and I imagine that our underwriting will change if there's an administration change going into next year, and we'll adjust our models based upon anticipated changes in the law.
Well, and that uncertainty is impacting other things too. Look at the stock market, right? Where that's going and how that ebbs and flows on day by day basis is very much dependent upon knowing some things and the lack of knowing, which is very, very concerning. Gentlemen, let me ask you guys to just comment on financing. Let's talk about financing just in general in today's market, how it's different. Is it readily available? Where are folks turning for financing of these purchases in today's marketplace? Andy or Tony, you want to get us started on that one?
Sure. So what's really interesting at least from our perspective on financing, the consistent cast of characters that are out there, they seem to have their financing set and in place, and it's pretty reliable. There haven't been too many financing related issues. But what's been really interesting, and this happened a little bit before COVID and actually was amplified some, but we've had a lot of folks that have approached the market and said, we'd like to put money into this space. How do we go about doing that? And so there's been a lot of interest in supplying capital to the market that we've seen. But as far as folks executing on that and buyers, changing their capital stack, I'm not really hearing about anybody doing anything, because it sounds like, at least from the folks I'm talking to, that they're comfortable with what they have. That's been the general feedback I've been getting over the last several months.
Tony, Greg?
I would echo the same thing that Andy said. We've seen a number of people that are trying to deploy additional capital into the market, but really it's a fairly significant process to get a buyer that is entrenched with a financing group today to go through the exercise of changing where they're sourcing their capital from. I don't think there's an issue with ability to deploy capital. It's one, there's just not enough volume for these new entrants to kind of come and play with. But most of the buyers are fairly happy with what they've gotten, the relationships they've built over time.
Hey, Greg, can you talk to specifically about what you guys are doing from a funding standpoint, but also how you're seeing, I'll use words like a competitor out there, other funding alternatives out there. How are these coming along? Do you think that it's taking a while, a lot of hurdles that have to overcome? I mean, my opinion is, I'll say this as a novice looking in, not my opinion, but interest rates are basically effectively zero, right? So there's got to be a lot of cash out there, and there's too fewer deals. So I would think financing is
you're exactly right.
Readily available. Now, go.
Yeah, you're exactly right. And so, the way I view it, it's a cycle, okay? And depending on what's going on in the economy, there's either a bunch of guys that are dying to get into an alternative, specialty finance space and deploy money in these assets that they had never really heard about in the past, because they were mortgage real estate guys, or because they were land guys, or whatever it was, or stock guys. And now all of a sudden somebody told them about, hey, you can make some great returns. Have you ever heard of this thing called distressed asset purchasing? And so And so we go through this cycle every couple of years where, depending on what's going on in the economy, we get a lot of people kind of, I don't want to call them looky-loos, because they're looking deep into the industry and they're trying to find ways to deploy money. The problem you run into, though, is you need to have a very experienced front end, either a partner that knows what they're doing or somebody that's deploying that money in an intelligent way, because it becomes very easy for somebody who has a lot of money to drive up prices, and it takes 24 months before that comes home to roost. And then all of a sudden you end up with a portfolio that's not performing. The investor gets turned off from the industry, takes their losses, the debt buyer, collapses or has to sell that inventory to somebody else, or find another investor. And so, and we see this continually in this industry. We always hear about one or two players of size that they kind of fade in or fade out of the marketplace because they weren't disciplined in their buying. And a lot of times that's the function of an investor that comes in thinking that they can make, incredible returns very easily and set up some terms that allow somebody to go out and buy large tracts of debt without doing the proper underwriting. And so, right now, I think there are a lot of people that are, I think a lot of the folks that are in our position are currently reevaluating their capital stacks, finding out if there's less expensive money out there, that savings gets pushed down to our debt buyers. Our debt buyers are then able to be more competitive on the stuff that they buy from the folks like NLEX or Garnett. And ultimately, the creditor benefits from that because they can drive a higher price.
Yeah, you're talking about also a more efficient marketplace. And I think that tremendously benefits all participants except those newbies that want to get involved in the marketplace, but they change things, they overprice things, they don't necessarily understand things as well as those experienced veterans on all sides of the transaction. Let's change gears here. In less than a week, we have an election. I don't know if anybody truly believes that on November 3rd, we're going to have a decision, but we're going to have an election, okay? So let's not get overtly political here, but we're talking about unknown outcomes. We're talking about anticipation expectations. Let's go around the horn. Let's talk about the election any way you want to talk about it, but it's definitely on our minds. How's it impacting your businesses? Tony, let's start with you.
Sure. Obviously, it's been a major topic that most of our sellers have brought to our attention. And
You don't say.
yeah, well, one of the things that we are doing is, even though volumes are down, we are planning to test the market with the same products for resiliency on pricing. If there's a change that occurs in November, we'll probably be out to market with 4 or 5 of our current buyers that have flows just to test where pricing, what impact does this have on pricing? And we'll make decisions, on future strategies of when these offers come out of, based on the results of the pricing exercises that we'll go through.
Thank you, Tony. Andy?
It's interesting because the conversations we've had on, both sides, at first it started off with, okay, here's what we think will happen if the administration stays the way it is. Here's what we think will happen if it changes. And, there was concerns about both sides and what would happen. But then what was interesting is that the conversation actually started to center on what happens if we don't know, and how long is that going to be, a problem. Clearly, our system is supposed to have rules that will ultimately time limit that. But as we were talking about earlier with, hey, we don't know if these things are going to come to roost in 3 months or 9 months, all of a sudden the question then, their responses were even more amplified. Well, okay, if we knew that we would have either a re-election or a change in administration on November 3rd, that 3 month to 9 month window is now 3 months to 9 months. But with this new known, or with this uncertainty with everything that's going on, with all of the other political hot buttons around, will we know who it is? That's first off, that 3 month to 9 month window is necessarily extended by that period of time. But now also the things that everybody thought they could plan for under a re-election or a change in administration, they suggest that they're throwing some of those ideas out the window because the pressures on both sides have, kind of changed the view. So things that they thought were so certain under, choice A or B, they're now less certain about those things. So, that's what I've really watched, is this evolution of, I'm very certain about what'll happen, in A or B, or, now to I'm much less certain, and the unknown potentially could extend a lot longer.
Greg?
It's once again, it's just more uncertainty, right? And so as we talk to our customers, how do you deal with uncertainty? I mean, you have a situation where either the Democrats or the Republicans could win the White House, but then what happens in the House and in the Senate? Because that slows down legislative change depending on if there's some conflict there. So the advice we've been kind of giving to our debt buyers, and what we're looking at, is the best way to combat this uncertainty is with diversification. Can we get into some stuff and finance some stuff and work with our debt buyers to get into some less politically charged transactions? So, for instance, one of the very difficult assets for us to finance are student loans. It's a very politically charged asset class. And with some of the talk from senators about maybe forgiving that, there would be an impact. Even if it didn't affect private student loans, there could be a socioeconomic impact to people's willingness to pay those debts, which would change the curve. So how do you defend that type of or defend that kind of exposure in your company? Well, you try to deploy in asset classes that are not under that type of scrutiny. The same type of talk that's happening from a student loan perspective, you hear grumblings about medical debt. Could that be forgiven? And so if you have a portfolio that is heavily weighted in medical or heavily weighted in student loans or heavily weighted in real estate, there are some direct implications to your business. And so since you can't really predict what's going to happen, and it's very difficult to figure out what Congress is going to do and what they're not going to do, your best bet is to diversify and try to get, balance your portfolio. And so that's kind of what we're focused on, is how do we help our clients get into some other asset classes and leaven out that risk.
Excellent points. When I look at an election, in addition to all the complications, all the uncertainties that the three of you very well covered, I look at two things here. First, regulation. When we had a change in the marketplace or the administration just 4 years ago, we were feeling really, really good that specifically Dodd-Frank and the byproduct of the CFPB would be closely scrutinized, maybe changed, maybe done away with. There were a lot of discussions about that. We all remember that, painfully so. Well, unfortunately, the current administration, maybe because they had so many other things that they needed to deal with. Like I said, I don't want to make this a political discussion, but the matter of fact was Dodd-Frank wasn't adjusted, and CFPB still looms large. In fact, they've ratcheted up enforcement. We just saw it, 2 weeks ago with Encore, right? So we're seeing it with service providers right now. So those changes, or those anticipated changes, add to uncertainty. Regulation adds to uncertainty. Not knowing when the CFPB final guidelines, which they say is going to be by the end of this week, right? Happy Halloween, everybody. We're all going to be reading about changes in legislation. But that being said, I, for one, am watching Friday the 13th and Halloween, no matter what people say. But but that's just me. The other part too is tax. The tax implications are going to be considerable, especially if capital gains becomes at the same level as ordinary income. You start looking at these things, it's going to create a either a fire sale, right, or a huge surplus, one or the other, not both, as a result of this. And we see these catastrophic kind of pendulum changes, right, in the marketplace, depending on who's elected. And these are the things we can grasp. There are a number of things we can't grasp, like the social unrest right now and how our police departments are going to change in our communities, right? And that has an indirect impact on how everybody conducts their business. Work from home. Every conversation that I have right now around these roundtables in preparation for Revolution is about the work from home model. Will it continue? We're all kind of working from home, right? Will it continue? Will it not continue? In our respective businesses, it will continue. But for collection agencies that are closely monitored by their clients, we don't know if that's going to continue and how's that going to impact licensing. So there's a lot of moving parts right now that will be coming together, hopefully in the short term, and then we're going to readjust our thinking. One more topic, gentlemen, that I think is very important is your outlook. Look, gaze into our crystal balls because we know they're perfect and 100% accurate, right? All the time. There's no question about that. But let's gaze into our crystal ball, specifically around changes in this industry from a consolidation standpoint, from a fragmentation standpoint. The changes in the industry over the years have been substantial. We saw a tremendous amount of both attrition and consolidation right after the financial crisis. Saw a lot of changes, a lot of coming together in the marketplace, people selling portfolios, not being interested, their entire portfolio, and not being interested in kind of staying involved, whatever. But there was some consolidation. In addition to consolidation, I just want you guys to look out over the next 2 to 5 years. Where are we going to be with debt buying? Let's start with Andy this time.
Oh boy, that's a pretty loaded topic.
Then let's start with Greg this time.
All right, Greg.
Go ahead, Andy. You can talk about outlook any way you want. I've just tried to give you some guardrails. That's all.
No, I appreciate that. So, like you said, there was a lot of consolidation. We saw a lot of consolidation in the marketplace before, but that also involved moving a lot of accounts around. And one of the things that we see is, and I'm sure this is consistent across the board, nobody will be surprised by this, but there's a lot more contractual prohibitions on doing certain things. And so, when I think about consolidation, I think there's been a lot more barriers to consolidation because you can't just go and resell your portfolio the way that you could 10 years ago. Most creditors have said, either no or limited, or the barriers are so high, it's not worth it. And so, I don't think that there's going to be as much consolidation as there was historically. To the extent that there is growth, one of the things Tony said earlier was, you've got I don't remember the expression, but I'll just say the rat through the snake. You've got charge-offs that are coming and that are going to come out. And right now what we've got is a little bit of vacuum from the debt buyers. They're looking around and there's just not enough inventory. And, there's going to be more inventory coming out for that vacuum to be filled. Now, will it all be sold or will folks want it serviced? That's one of the things that I'd really like to get some perspective on from others. But, at the same time, you talked about work from home and the outlook there. Just a little nugget of information. We've actually had some folks where their selling requirements specifically prohibited any kind of work from home. From an agent perspective, you just couldn't do it. And now what we've seen is a migration towards, if as a part of your disaster recovery plan, you don't have an adequate way to have agents work from home, then we may have a problem here because of what we've experienced recently. So, I actually see that as being one of the shifts to, folks' survival, is to be able to adapt to the agents working at home in a compliant way? How do you measure that? How do you do that on an ongoing basis? Because that's where some of the creditors have just made I mean, it was a switch on and off change. And you just couldn't have projected that. So stop there.
Excellent, Andy. Thank you. Greg?
I'm an optimist by nature. I think our industry will adapt and change, and will survive. I do believe there'll be some consolidation. I think that we really, one of the things I always look to is what's happening with the sellers. If there's massive consolidation in the selling field of the folks that are selling, then I think you're going to see that follow. That you're going to see massive consolidation in the debt buying and in the collection arena. But as long as we have new issuers and new fintechs, lenders popping up, they're going to have a need for that liquidity for their charge-offs. Maybe a Citibank or more appropriately a Chase or a B of A views that those sales channels as a very small piece of their economics, and they're willing to give that up. I don't think some of the mid-sized and small-sized lenders have that ability. And so I think they'll fight to keep that in play, to keep that liquidity in play. And so as long as they continue to grow and new players come into that market, I think you'll see the debt buying industry and the collection agency industry kind of mirror that.
Well said, Greg. Thank you. Tony?
I'm glad I got to go last, because really a lot of what these guys have already said. At the end of the day, I think that there'll still be a market. I think that we'll still have new entrants. At some point, even the larger institutions that backed out with the last economic decline, and they're still working to perfect their control so that volume will be out there from those guys at some point. But from a consolidation perspective, I think it'll be much less this time around than the last time. And at some point with that volume that's going to come through, I think there'll be enough volume to go around for a number of buyers. So.
Excellent. Thank you all. One last thing. When I do roundtables, I like to do this. A little bit of a surprise. And that is, if you're sports fans, you know where I got it from. But I like to have a parting shot. Okay. And it could be about anything. You guys have spent a lot of time in this industry, and you've also been gracious with your time today, which I greatly appreciate. So if you want to make it self-serving about your own business, you can go for it. That's fine. If you want to talk about just generally how you're seeing things, I'm giving you a chance to think about it by giving you some ideas here. But generally speaking, you have a parting shot. You're talking to your potential and current clients. What do you want to say to them? We're going to start with you, Greg.
Oh my gosh, it really kind of put me on the spot there.
Yes, sir.
I just think, yeah. I think we feel we're very bullish about the industry. We're very bullish about the opportunities that are coming down the path in 6 to 12 months. When we talk to our investors, we're encouraging our investors to invest in deploying capital in this market. We don't think that the credit market or the bad debt market is going away, and we think ultimately it's going to grow over the next 2 to 3 years. But I also say that with a little bit of caution, saying that I really think it's important that you diversify and that you build a balanced portfolio across various asset classes.
Thank you, Greg. That was excellent. Andy, you're up.
I wasn't expecting this one either, but one of the things that I guess I would just tell everybody, and this is a quote from one of my favorite people in the industry, and it's used often, and they say, collections are hard. And there's an awful lot of things that we've talked about today that make it hard on both sides of the trade, whether you're a seller who you're trying to figure out what to do because that's not your business. Your business isn't debt collecting. Your business is lending. And there's all sorts of regulatory requirements and all sorts of things that are difficult that make collections hard. From a buyer perspective, you've got all of the regulatory challenges, and that is their business, is quite frankly dealing with the regulatory the regulatory changes that are coming at them. They have to adapt and be ahead and watch what everybody else is doing, and making sure that they're complying with it. So with all of this, if I could say one thing, it would be to encourage you to continue to look at whatever it is that your strategy is. But going back to my quote from a good friend is, collections are hard, and all of the things that you have to think about are hard, and you have some great options, and you have some great partners that are out there in the industry, and that's what we're all here for.
Thank you, Andy. Tony?
Yep. I think that the panel here, we've got tremendous experts within the industry. So just continue to navigate the waters. If you have questions, don't hesitate to reach out to any of us, because I think that we can help you avoid some of the pitfalls that you may experience in this time of change. I think it'll be a positive outcome for everyone from the total industry perspective. So
Thank you, Tony. And I couldn't emphasize that one enough here. Before I give you my parting shot, I'll just say this. These gentlemen know this stuff. They live and breathe this stuff. They live for this stuff. They're in this marketplace for keeps, as evidenced by their history. So I'll just say this, leverage them. They know what they're doing. You have options out there, and that's great, but make an informed decision in everything that you're doing. They're available. Reach out to them, compare, contrast, and make informed decisions. My parting shot is around one word, and that is assumptions. I learned a lot today from these folks, and I was really just kind of thinking about how do you kind of summarize what we're talking about, all this uncertainty. There's aspects of this industry that are mature and changing. There are aspects of this industry that are relatively new, dynamic, and also evolving. But as a credit economy, there will be a need for these services, not just today, but ongoing and indefinitely into the future. These are absolutely critical decisions. And whether or not you're looking at underwriting, you're looking at the performance of your assets that you own, new assets that you're going to purchase, the list goes on and on and on, financing. Be rock solid with your assumptions. Don't ignore economic conditions. Don't ignore macro and micro industry and broader critical components. Don't ignore what your banks are telling you, what your lenders are telling you, and what the professionals are telling you. Then make your own assumptions and make sure they're fluid enough that instead of just kind of putting them down yearly and saying these are assumptions, revisit them on a quarterly basis. Adjust appropriately. Always have kind of an outlook that is relevant to the circumstances, because like I said before, we're going through an election. I don't think on the 3rd we're going to know definitively. That's my feeling. Some of us think we already know the outcome in advance. We thought that way 4 years ago. So it's going to be an interesting process and an interesting outcome. There's no question about that. But that's just one factor. Know what's going on in the markets that you service and make informed decisions. And I think the reason we all came together here today is because we believe this is going to continue. We believe there's a lot of value to be realized. And these guys don't run non-for-profits, okay? They're in the business of making money. We're all in the business of making money. Don't nickel and dime them, because it's just not worth it. At the end of the day, they add value, pay them for their services, and pay them well for their services, because they have options too. But as I kind of think about this, and I think about the long haul, I really can't emphasize enough how important it is for folks like Tony and Greg, Andy, maybe even myself, to come together, talk about what we're seeing in the marketplace, and encourage you guys that, hey, I follow Greg's philosophy. I'm a glasses half full kind of a guy also. I'm your eternal optimist, maybe your cheerleader, but I also come about this very critically. very, very critically. So, and I encourage you all to continue to do that, scrutinize and over scrutinize, make decisions though, and move forward. Don't get paralyzed by your assumptions. Make decisions and move forward. Hindsight is always 20/20. And on Monday, we'll sit back and we'll rip apart the quarterback's performance over the weekend, because we all do that, but they're the ones on the field, just like these gentlemen. So thank you all. Thank you for your time and your patience in participating. I direct that to our subject matter experts. I want to emphasize just one more thing, which is they were carefully selected, and I think they did not at all disappoint. I've walked away, I had 3 pages of notes, and I'm not even looking to buy debt, because I think that, you know, at the end of the day, I sharpened my pencil too as a result of this. So thank you, gentlemen, for your time and your cooperation today. It's greatly appreciated.
Absolutely. Thank you, Mike.
Thank you.
Hello again. That was a wonderful roundtable, wasn't it? I learned a lot from our wonderful speakers, and I'm sure you did too. Before we finish, I want to quickly go over Q&A. If you asked a question in chat and hasn't been answered already, don't worry, you'll receive a response within 24 hours through email or another similar channel from one of our SMEs. In addition, I highly encourage you to connect with our speakers through the platform. They're extremely knowledgeable and they're super excited to share their knowledge with you. So I definitely encourage that. And feel free to reach out to us too, and to Mike, because I'm sure he'd love to talk with you as well. So once again, thank you for attending the Business Revolution Week, and I hope you have a wonderful day. Thank you.